Let's look at Eldorado Resorts, and we're going to find out the intrinsic value of the company stock. First, let's get the market cap, 2.6 billion. And now let's see the stock price, 33.54. So they have about $78 million shares outstanding. So we're going to figure out the future free cash flow of the company, then discount it back to today's dollars, then divide that number by 78 million, and that will tell us the intrinsic value of the stock. And we'll see if it's a buy or a sell. And free cash flow is a great way to see how a company's doing because it's actual cash that goes in and out. It can't be changed by accounting. And free cash flow can be a little lumpy because if one year a company invests a lot of money, like maybe 2016, 2017, they may have invested a lot of money, and the cash flow went down a lot. And then another year they may not have needed to spend as much money. Maybe they did a lot of improvements or bought a lot of equipment, so it wasn't necessary. So net income is next, and that is the profit on an annual basis after each year. And the reason it can be manipulated is because when you buy something like a building, you depreciate it on the income statement. So you only get deducted maybe 10% of the asset each year or 5% each year. Where on the cash flow, it's everything. All the cash flow that you paid is gone. So net income, it looks like it was pretty low in 2016, but then tripled, then went up again, went down a little. So it looks like it's in the right direction. Let's see the revenue from year to year. And this is just the sales from the casino. And they had a pretty nice jump from 2016 to 2017, and another nice jump. So it looks like they're in the right direction. So you can see it moves kind of the way you expect a company to move. It increases at a steady rate, where net income and free cash flow are all over the place, especially free cash flow. Now we need to figure out what to discount the future cash flows by. So let's get the interest expense that they pay on their debt. So $286 million on the debt. And then let's see how much debt they have. So we first need short-term debt, which is debt due within a year. And that's $246 million. And long-term debt, which is debt due beyond a year, that's $2.3 billion. So they pay a hefty interest rate on the debt. So they must have a bad rating, because that's one of the highest interest rates I've seen, 11.13%. That indicates it's a risky investment. Now, let's find out the income before taxes so we can figure out their effective tax rate. And the income tax, Hmm. 35%. So they pay a good tax rate. They don't have many write-offs or deductions. So when the interest on the debt is 11.13%, and then you have to discount the taxes. So you take 11.13% times 1 minus the effective tax rate, and the cost of debt is 7.2%. Now, we need to figure out the cost of equity. I imagine they probably have a high beta. Yeah, really high, 2.61. So that means it moves 2.5 times the market. So the capital asset pricing model is 22%. That's the cost of their equity. So when you blend the cost of debt and the cost of equity together, and you blend it based on the weight of the debt and equity, and it's actually 50-50. It can't be exactly 50-50. It just rounds to 50-50. So the cost of getting money is 15%. So the weighted average cost of capital is 15%. So you discount the future cash flows by that 15%. And we calculated the future free cash flow using the numbers I input earlier. And we calculate 4 years of free cash flow, and then we get a terminal value. And this is the formula for the terminal value, which is similar to the Gordon growth model or the calculation you use for a dividend discount model. If you're familiar with that, you could just Google that term. And we discount the free cash flows, the expectation back to today's dollars, and we say the stock is worth, the present value is 2.9 billion divided by the 78 million shares. So we're saying the stock is worth $36.72 according to the model. That's what we say the intrinsic value of the stock is. And it's interesting to see how close it is to the actual stock price. So the stock was trading at well above intrinsic for a long time, and then it dropped off a cliff in March due to coronavirus, and you could have gotten a discount below intrinsic, but it's come back up like most things. So knowing the past is important, of course, knowing the numbers of the company and how they've been performing, because that's all you have to go on. But the part of an analyst is to predict the future, which is really challenging. How will the company perform in the future? Will it be performing better or worse? A lot of people think worse because coronavirus is affecting a lot of businesses, especially the gaming industry. Now, if you have any other ideas and any thoughts on this particular company, please leave some in the comments. Thanks for watching.